that nothing in life is worthwhile unless you take risks. Nothing. Nelson Mandela said, "There is no passion to be found playing small and settling for a life that's less than the one you're capable of living."
Okay, the second most important thing on your trading plan is to use patterns. Patterns. That's because patterns, like we said, after a market pricing period of between 9:30 and 10 to 10:15, the market have already priced where that stock is going to be for that day. Therefore, the pattern is very important thing to actually realize, or to recognize and to use it to your advantage. Patterns are the graphical presentation of price movement. Graphical presentation of price movement. It will show you where people bought and where people sold. Why people are buying it here, why people are selling it there is none of our business. But there is a natural support and resistance area that you can use to profit from. Therefore, patterns are very important things. Let's talk about what Mark Douglas says. If you ask me to distill trading down to its simplest form, I would say that it is a pattern recognition numbers game. We use market analysis to identify patterns, define the risk, and determine when to take profits. That's Mark Douglas quote. If you don't know Mark Douglas, please join our YouTube channel at Day Trading Fans on YouTube, and there's a library of his videos. Mark Douglas is a trading coach that he was one of the greatest trading coaches that ever lived on this planet, and he turned people around huge. He turned me around, made me from consistent loser to consistent winner just by listening to his videos. For this particular part of the video, we'll talk about the support and resistance. We talk about it because it's very, very simple for those who are new to trading, but there's a lot more patterns that we can discuss on this particular trading plan that we're going to send you in an email. I think there's about 9 different trading plans, 9 different patterns that you can profit from. But to make this short and to show how you utilize your trading plan, we're going to use the easy support and resistance trading strategy. Support is the price level at which demand is strong enough to prevent the price from further decline. Every time it comes down, people jump in, they say, all right, the stock is cheap, let's buy in. Resistance on the other side is the price level at which selling is strong enough to prevent the price from rising further. Comes to this, and nobody wants to bid the market up. Everybody wants to sell. The sellers are a lot more than the buyer, therefore they bring the price down. Let's see that particular chart. It goes here, comes down, doesn't really go to support, comes up, back up, doesn't really come to resistance, but it shoots down and bam, bounces right back up, and bam, bounces right back up. Doesn't reach support. It reaches support a lot, quicker. It stays in the trading range, comes here and bam, shoots back up. Trading range, comes to the support level, shoots back up. It hits the resistance level, shoots back down, all the way down to support, and it continues to do that in a trading range. Now there is other trading strategies where you can actually use the breakout. So let's say it breaks out, when to buy is the question. If it breaks down, when to sell or when to short is the question. We're going to show you that in a different, if you ever join us. Trading range. We just spoke about the support and resistance, and you can see it on that particular chart. This particular stock in a trading range for a certain period of time. Okay, trading range plays an important role in determining whether support and resistance functions as turning points or continuation pattern, which means every time it hits support and resistance, that pattern is still valid, still valid, still valid, still valid. until it comes to a point where it breaks out. Now, when do you buy that? There is a way to buy that. If that breakout is confirmed and continues to shoot back up, you buy right here. But what happens if it shoots back down? There's probably a market manipulation. Somebody wanted to create the false breakout to bring buyers in and dump his shares. And it happens all the time, no issues. So he created a false breakout and then shoots right down and bam, he's dumping his shares at a higher price. Because if he dumps his shares anywhere here or here or here, he's going to create this. So he has to break through that particular resistance level. He brings buyers, he sells right here at a higher price before he dumps his shares. And once he dumps his shares, everybody else does, and bam, it goes all the way down. So it's very important to recognize when the support and resistance work and when it breaks. If it breaks, be very careful. It could provide you with a nice breakout buy opportunity. It could provide you with a short opportunity. It depends on what happens to the price after the breakthrough happens. Okay, support and resistance. Where do you enter is the question. Support levels present a buy opportunity or entry point. This is very simple. We're not going to spend too much time. You already established this is your support level. This is your resistance level. You put your orders to buy right here and to sell right there. So if it hits, you don't even have to watch the chart anymore. If you establish this is your support and resistance, and you're a hard-working man on your 9-to-5 job, but you still want to profit from the stock market, you just create, okay, I'm going to buy at 9 and I'm going to sell at 10. Every time it hits 9, I'm going to buy 100 shares. Every time it goes to 10, I'm going to sell 100 shares. And therefore, you can automate your buy and sell orders in a way that you can be away from the chart and still make money. Now, it's very important for this, if you're not going to watch the chart, or even if you're watching the chart, is to establish what? What are you going to establish? Stop loss order. You have to define your risk as according to your plan. So if it hits, if it breaks out, if it goes here and does not bounce back and it boom, it dumps, then you didn't lose much. You probably lost 10 cents, but if it shoots back up to 10, you made $1 per share. Therefore, your reward to risk is 10-to-1. That's how you make money in the market. Here's another example of a support and resistance pattern. Shows you where the resistance level presents you as sell opportunity or exit point. You sell here. What else you could do? You can short right here. And then what do? You put your stop loss. This way, if you short here and the market doesn't do this, the market goes like that, boom, you lose very little money. But if the market goes down and you buy here, you're making a lot more than you're losing. Predefining your risk, putting a stop loss in the market. I cannot tell you how much resistance people have against that. People do not want to put a stop loss. People put a stop loss and they move it. People put a stop loss and they completely remove it. People just, don't want to admit they were wrong, and they think the pattern betrayed them. The market betrayed them. It's not them. It's the market that actually caused them to lose. It's not the market. It's the trader. Okay, when you join us, we're going to teach you other pattern strategies. How to buy resistance breakout. How to buy a climactic decline. How to buy double bottom. How to buy inverted head and shoulders. And when to buy it. How to buy tweezers bottom. I love tweezers bottom. I make most of my profits from tweezers bottoms. Amazing pattern. Amazing. instead of giving you a one trigger bar, it gives you two trigger bars. It confirms the pattern, confirms the move. There's no better way than the tweezers bottoms, in my opinion. Rising 21 moving average. Now, I can tell you a lot of people online, they are teaching the moving averages. The problem is they're teaching the moving average as a real, it is a strategy, but they teach them as if the moving average, if the stock comes down to the moving average, the stock is going to bounce right off of the moving average and goes back up. That is not true. If you ever took a course or you have a mentor, he tells you the price is going to bounce off the moving average, you're being deceived. Because what happens is that moving average is a lagging moving average. It follows the price move. That moving average is right there because the price put it there, not because the price did not bounce on the moving average. The moving average caught up with the price. We're going to teach you how to use the rising moving average or the declining moving average in the right way without putting so much emphasis on it on a way that will make you lose money. I can tell you when I started, I took one of these classes that you just all they taught is nothing but a simple moving average. And I realized everybody's teaching it, so it reinforced my perception that the price will react to the moving average. And it took me, I can tell you, probably $750,000 of losses to realize there is a time and place to use the moving average, and it's not for a beginner trader. That moving average is more of somebody that already been trading the market for a long time, already knows what to do, already understand that moving average is a lagging indicator, and knows how to manage the risk. Does it work? Yes. Does it work for beginning traders? No, it will not. It will make you lose money. I promise you that. And if you ever been losing your money due to the moving average, please share your story with us, because we would love to actually use somebody's real story to show if they made money or lost money and show other traders the proper way of doing it. Okay, other pattern strategies is the sell strategies or the short strategies. How to short the support breakdown, how to short the rally, the climatic rally, how to sell or short the double top, the head and shoulders, how to short the tweezers tops, how to use the declining 21 moving average to benefit from the market. Again, this is more of an advanced indicator. This you have to be very careful with if you are very new to the trading career. Your trading plan is going to show to you like this, just like that, on a PDF format. You're going to mark you actually bought the support level, you bought the tweezers bottom, you sold the climatic rally. Whatever your trade is going, however you done it, you need to mark it. This way you log in your trade. It does not just give you a trading plan. It gives you a trading checklist. It gives you a trading log. You can print that out, or you can use your handwritten one and keep it in a folder. At the end of the week, doesn't matter if you're winning or losing, you need to come back to it and look at it and see what worked for you every time and what didn't work for you every time, and then you can adjust your trading plan, and we can help you do that.